My guest today is Jonathan Duong. I had Jonathan on the podcast a few months back where we talked about how to select the best indexed funds, which folks found insightful, thankfully. But there's a related topic to fund selection around asset location, which is about where it's most advantageous and tax efficient to hold different asset classes. So I invited Jonathan back to the podcast today to share tips and insights about this critically important topic. If you want to make sure your investments are optimally allocated from a tax and withdrawal strategy perspective, then you definitely want to tune into today's episode. Quick background on Jonathan. He's the president of Wealth Engineers, a Denver-based fee-only financial planning and wealth management consultancy that is focused on low-cost asset management. He previously served as the director of investments for another Denver-based wealth management firm. And he also worked in Ernst & Young's transaction advisory services group, where he focused on advising corporate and high net worth clients on investment, tax, and planning issues. He holds both the CFA and CFP designations. Jonathan, thanks so much for joining us today to share insights about asset location, excuse me.
Yeah, good to be here. Glad to have the conversation again. And I think it's a really good follow-up from our last discussion. So
cool. So for those folks who aren't familiar, maybe they didn't catch the last episode, just really briefly, what type of financial planning do you do? What makes your approach different?
yeah, so I'll try to cover. We're going to try to cover a lot of ground today, and I think a good preface for that is just our approach when it comes to working with our clients. It is very tax centered and very tax focused. So we're a fee only registered investment advisory firm based in Colorado. We tend to work with clients who certainly oftentimes are high income earning or high net worth or both, and so tax planning and tax strategy is very central to what we do. That's of course, not only relates to portfolio design and asset selection and, building a portfolio using multiple different types of accounts. Some of our clients may have 5, 7, 10 different accounts between, IRAs, Roth IRAs, workplace retirement accounts, trust accounts, taxable accounts, all kinds of different things. And so, it can tend to get fairly complicated. So tax planning and strategy is a big part of what we do. And we really integrate that along with all of the other considerations that, somebody who's really looking at their wealth and managing their wealth holistically needs to consider. And so that's everything from thinking about the impacts of these decisions on Medicare, on, gifting or estate planning, thinking about asset protection, just a lot of different things that come into that. And so this is a theme for us in terms of asset location that is very central to what we do with our clients.
Okay, cool. Before we actually dive in, I'd actually love to make sure folks sort of level set, have a shared understanding of what we even mean by asset location. And so when you say the term asset location, what do you mean exactly?
Yeah, so I think it's easy to get kind of tripped up because there's two in the world of investing and personal investing. There's kind of two terms that are very often used. I think the more common, term that sounds similar is asset allocation, and obviously we talked a little bit about that in our last discussion. Asset allocation predominantly, being the focus of what percentage of your portfolio is in broadly, let's say, stocks, broadly in bonds, and maybe you also are including commodities or real estate or other asset classes, and then what percentage of your overall portfolio is in each one of those slices, right? So that's what we call asset allocation. Asset location, on the other hand, is really a concept of, now that you've established what your portfolio is going to look like, where do you actually buy and hold those individual securities or asset classes, right? And so for an investor who, let's say for sake of argument, you're only investing in your 401k, then frankly, asset location doesn't really matter all that much to you because you don't have any other place to put stuff. The only place you're putting things is in your 401k. There are still some tax considerations that, need to be taken into account. But for the most part, you're not really too worried, because if an asset is super tax inefficient, it doesn't really matter to you because you're investing exclusively inside of a tax advantage account like a 401k. On the other hand, for an investor with a more complicated situation, you might have, tax deferred accounts like a 401k or a traditional IRA. You might have tax exempt or tax free accounts like a Roth IRA or Roth 401k. And then you may have taxable accounts, like a trust or just a brokerage account. And when you have multiple different buckets, so to speak, then you kind of have to decide, and I always use cooking analogies, or I like to use cooking analogies. Are you going to bake the exact same pizza in every single one of those accounts with all of the exact same ingredients? That's one approach. tends to not be as preferable from a tax perspective or a transactions cost perspective when you do pay trading costs. Or the other option being you pick and choose certain ingredients for that overall pizza. That overall pizza is your total portfolio, and you pick and choose which ingredients go where, such that each individual account is not going to look like the whole pizza, but when you add it all together as a total portfolio, then it'll look like the pizza that you want. And that's what when we're talking about asset location, it's which ingredients go where when you have multiple different types of accounts.
Perfect. I like the analogy. Easy to grasp. Okay, cool. So as you alluded, there's taxable accounts like regular brokerage accounts. There's tax deferred accounts like 401ks and IRAs. There are tax-free accounts like Roths, even HSAs and 529s.
Yep.
When it comes to asset location, what are best practices, general principles in terms of allocating different asset classes into these different types of investment accounts? And then later we'll get into some specific asset classes, but at least want to get your thoughts on a general framework for, general principles for how to do asset location thoughtfully.
Yeah. So, I mean, I think this both, it does apply both in terms of an individual taxpayer's circumstances, but it also applies based on the current environment that that we're currently in and how it compares to, to history. So I'll definitely just, kind of take the quick second here just to certainly say that obviously none of what we're talking about here is investment advice. You should certainly consult with your individual, financial planner or financial advisor and tax advisor, legal advisor as appropriate. So, certainly, everything that we're talking about here is pretty broad in its, in its discussion, not obviously specific to a certain circumstance, and just recognizing within that kind of compliance disclosure that I'm offering that part of the reason that is so important is because all of these, concepts are facts and circumstances driven. So, in terms of the broad discussion around, historically, what would be a rule of thumb for asset location is generally, you want to use your tax advantaged accounts, like an IRA, 401k, or Roth IRA for those assets that are less tax efficient. So generally speaking, that's going to be fixed income or bonds, taxable bonds specifically, where the interest that's earned, and it's obviously on a bond, the primary component of your return is going to be interest income. It's not going to be capital gains. And so that interest income is all going to be taxed at ordinary rates. And in general, you want to minimize your ordinary income because that's going to be taxed at a higher rate typically than what you pay on qualified dividends or long-term capital gains. So I'd say throughout most of modern history, you'd want to put, let's say, bonds, for example, in your tax advantage accounts, and you'd want to put stocks in your taxable account as an example. Other asset classes kind of have a hybrid characteristic or a hybrid profile between whether they tend to be more tax efficient like stocks or tax inefficient like bonds. So sometimes you have a really hard decision about where an asset class goes, and that may lead you to either not investing in it at all or just accepting that it's not an ideal tax circumstance. So I'd say broadly that's kind of the historic rule of thumb. What's of course challenging is now being in an ultra low yield environment. Some of those rules of thumb deserve to be challenged and reconsidered depending on your specific tax circumstances. But frankly, that's something you should have been looking at, or people should be looking at, in my opinion, all the time anyways. There is no single rule of thumb that's always going to be appropriate because the tax situation for one investor versus another could be drastically different. So.
Okay, cool. So generally less tax efficient investments in tax advantage accounts. That makes total sense. Are there any other rules of thumb that you typically advise folks?
Well, I think it really, the framework that I encourage people to think about, right, is before you even talk about the specifics of an individual asset class or individual security, and there is a lot of nuance and detail that needs to be understood there, but before you even think about that level of complexity, you really just start with a few basic concepts, right? So you start with one, how much tax advantage space do I have, right? Do I have a significant amount of IRA, 401k space available, to me? Or am I pretty limited in that regard because of my circumstances or whatever, my particular situation? So when I have more tax advantage space available, then I have a lot more flexibility and latitude of how to approach this. If I don't have very much tax advantage space available, we have some clients where 90+% of their assets are in a taxable account. They just don't have a lot of IRA space available for a variety of reasons. So the way that we approach this varies based on how much account space, what are the balances of actually these accounts, right? So that's the first consideration. Second is what tax rates actually apply, right? So you got to think about what is your ordinary income tax rate? Are you in the 10% bracket or are you in the 37% bracket? Those are two totally different situations, of course, when we're thinking about how these concepts need to be actually applied in practice. And then you need to look at, in addition to, your ordinary and your long-term capital gains, bracket, also need to think about, any applicable surcharges, right? Are you paying the net investment income tax, which is a 3.8% surcharge for investors who have incomes, married investors above 250,000, single investors above 200,000. Are you paying that? Because if you are, then your effective capital gains tax rate, might be 23.8%. As opposed to 20%. So that's kind of another consideration. You also have to consider state tax rates. So that's sort of another complexity that comes into play. And then I think in addition to that, you need to consider, as you're thinking about the actual asset classes and investments, is the yield on that investment or asset class, and whether it's an asset class that's going to tend to be more income generating or it's going to tend to be more capital appreciating. And all of those factors have to be taken into account when you're making decisions about which asset classes you're going to invest in to build your portfolio and where those asset classes and securities actually need to go.
Okay, cool. So I would love to jump into some sort of concrete examples so folks can sort of think about how they line up maybe to their own portfolio and how they might treat them in an optimal way. So let's start with stock holdings. So stock indexes, individual stocks, both the dividend paying variety and the non-dividend paying variety. What would your general sort of rule of thumb be for how to hold each of these?
Yeah, so I mean, in general, most stock index funds, open-end mutual fund or ETF, are going to be very tax efficient. In other words, they're not going to tend to generate a lot of ordinary income through short-term trading or anything like that. The majority of the dividends are going to tend to be qualified, such that they're benefiting from the long-term capital gains rate, as opposed to non-qualified, meaning they're going to get taxed at ordinary income rates. So,
and by the way, when it comes to qualified and non-qual, how do folks tell the difference, and what is the difference?
Yeah, so I mean, in terms of thinking through the difference between those, the primary difference that most investors care about is the tax rate that's applicable. So qualified dividends going to be taxed at long-term capital gains rates, whereas non-qualified dividends are going to be taxed at ordinary rates. Now, non-qualified dividends can be made up of all kinds of different things. So it can be interest income, it can be income coming or a distribution coming from, let's say, a real estate investment trust that's not going to be able to benefit from the qualified dividend rate. It could be any number of different things that make up that distribution and then ultimately a non-qualified dividend, for example. So primarily investors care about the tax rate. That's the difference between those two. For most US-based index funds, so let's say it's a total stock market index fund or an S&P 500 tracking index fund, I'd say in most cases 95 to 100% of the dividends are going to be qualified and are going to benefit from that lower income tax rate, the long-term capital gains rate. When you get into international and into emerging markets, if you get into small cap, mid cap and small cap funds, particularly internationally, then that percentage can start to dip, where of a given dividend distribution from a fund, you might be looking at, say, 60 to 90% of that dividend distribution being qualified, the remaining part being non-qualified. So, from a perspective of how you're actually going to approach these things, typically what you'll be able to do is if you already own the investment in your custodian, transaction history, they're going to break out and tell you whether or not that was a qualified or non-qualified dividend and so on. You go to your 1099, that will show even more detail. And then you can also go to the fund family website and actually see a breakout or breakdown. So a lot of what we're doing here this time of year in October, November, December, we're actually going to the fund family's website. They'll typically publish a PDF or an Excel spreadsheet calculator that'll actually allow us to estimate all of the year-end dividend distributions and income distributions for every fund that our clients own. And we can then go and tabulate out what we think that their overall portfolio income picture is going to look like between ordinary income, tax exempt interest, qualified, non-qualified dividends, capital gains, and so on. So all that level of detail is there, but you're going to have to do some work to uncover it. So long story short, in the particular asset class we're starting with here for US stocks, if it's a broadly diversified US stock index fund, it's going to be very tax efficient. So it's a good candidate for considering holding in a taxable account. At the same time, where this stuff starts to get pretty complicated, of course, is that the dividend yield right now on US stocks, for example, in a lot of cases is going to be higher than the yield on a investment grade bond fund, for example. So you might be seeing a 0.5% or 0.75% yield on a bond fund, and you might be seeing a 1.5 to 2.5 or 3% yield, depending on which particular stock index fund that you're investing in. So that's a situation where, yes, you're getting a better tax rate on that US stock dividend, because it's going to be typically a qualified dividend. So you get a preferential rate, but you're paying a lot more just in terms of income. It's just a larger dollar amount of income for a given dollar of investment because the yield's higher. So that's where this stuff starts to get pretty tricky.
Got it. Okay, cool. So then let's move on to bond holdings, both non-tax advantage bond holdings, whether they're indices or actual holdings, as well as tax exempt bonds like muni bonds.
Yeah, so we've kind of alluded to a little bit here, being in the low interest rate environment. Obviously, in a situation where, let's say, the interest income, the yield to maturity, for example, on a investment grade bond fund a handful of years ago might have been 3, 4, 5%. Obviously, that can be fairly punitive for somebody who's in a higher income tax bracket. Where if they've got a $100,000 investment in a given fund, if it's got a 4% yield, that's $4,000 of ordinary income, and you might be giving up 30, 40, even sometimes close to 50% of federal and state income tax, blended together. That's pretty punitive. Obviously, now we're in a situation where yields are so much lower that it can sometimes make sense for investors to actually hold their bonds in a taxable account as opposed to a qualified account like an IRA or Roth IRA or something like that. And then when it comes to municipal bond funds, in general, obviously the rule of thumb, of course, would be, municipal bond funds are really only appropriate in a taxable account where you're getting the benefit of avoiding federal income tax on that interest, which is very powerful. However, again, there's no one size fits all situation, because there have been instances in the last 12 months where the yields on municipal bonds, particularly when there was liquidity crunch right in the middle of the pandemic, where yields surged on municipal bond funds and municipal bonds, I should say, in general. And so you had a situation where the yield was so attractive that it actually made plenty of sense to hold it in a tax advantaged account like an IRA or Roth IRA, even though you typically wouldn't do that, because you typically would want to hold tax exempt bonds in a taxable account to get that tax benefit. So, this is a lot of ifs, ands, or buts, and it tends to get fairly complex. But I think the long and short of it is, it really depends on your tax situation. If you're a high income taxpayer, your high income bracket, typically you're still going to want to be very mindful about holding bond funds in a taxable account, taxable bond funds, I should say, and you might be better off with municipal bonds and then holding any taxable bonds in a tax advantage account. If you're in a low income tax bracket, it could be the opposite. It really just depends on your circumstance. And then we didn't really talk about it on the US stock side, but just to kind of offer it here as well for bonds, a lot of this is going to depend again on whether it's we were talking about index funds. It's also going to depend on whether it's index or it's active. If it's an actively managed fund, a lot of the implementation of an actively managed fund where there's a lot of turnover, there's a lot of short-term capital gains that are generated, that in and of itself can be, the singular decision that says, hey, this does not belong in my taxable account because of all of this taxable activity.
Yeah, and if it's an actively managed fund, do the short-term tax consequences hit you even if it's an ETF? Understand in a mutual fund, you might, sort of be exposed to that sort of tax drag, but in an ETF as well?
Well, so, it's going to depend on, obviously the way that the actual implementation of this is taking place, both in structure and in the trading of the fund. So obviously, I think we talked about a little bit in our last discussion around sort of these semi-transparent and non-transparent ETFs, and the fact that the ETF structure, because it allows for in-kind redemption and some other things, is going to tend to be a lot more tax efficient. However, at the same time, you're not going to necessarily always be able to find the exact strategy or manager that you want that has both an open-end mutual fund and an ETF. Although there are an increasing number of non-index ETFs that are available, they're not nearly as broadly available as open-end mutual funds. So you may find what you're looking for if you are you're seeking an actively managed fund. You may find it in an ETF structure, but it's still much more likely you're going to be finding it in a traditional open-end mutual fund structure, and then that is where obviously the tax issues do need to be taken into account pretty closely. So.
Makes sense. And a moment ago, you mentioned that given the low interest rate environment that we have right now, it might actually make sense, depending on the circumstances, to hold your taxable bond holdings in a taxable account. Is the theory behind that just to make more room in your tax advantage accounts for other, say, higher yielding assets? That's why you sort of sacrifice the lower yielding asset to take it out to make more room. Is that kind of the theory?
So I think it'd be both, right? So yes, one, if you have, let's say, a lot of Roth IRA space, then that can be a great opportunity to basically place your highest potentially your assets with the highest potential capital appreciation, in your Roth IRA, because that's a fully tax exempt account. So, you obviously want to let that run as long as you possibly can, given your tax situation, sometimes that changes a little bit, but you generally want to let that run and grow, and leave it undisturbed for the most part. So yeah, that can be part of it. The other part of it, just say for sake of argument, again, that you've got an investment grade bond fund. Let's say it's got a 0.5% yield for sake of argument. And then you've got a stock, index fund where the dividend yield is 2.5%. Well, you're in a situation there where you've got more than triple the amount of income that's going to come in the form of dividends from that stock fund compared to interest on that bond fund. And so it is true that the interest coming off of that bond fund is going to get taxed at a higher rate in most cases. It depends on your tax situation, but it is going to get taxed at a higher rate. But you're only, even though that's at a higher rate, you're only having a third of the amount of income. Whereas on that stock dividend that's coming out, you're having triple the amount of it. For example, in other words, you might have $3 of dividends coming in for every $1 of interest for the exact same dollar amount that you actually have invested, simply because the yield is so much higher. So it's really both of those things. It's considering, how do I optimize, for minimum lifetime taxation on my investments from a capital appreciation and so on, but also thinking through, even when there's a preferential rate, if I have triple the amount of income for that preferential rate, sometimes that may not be an ideal situation. I might rather have a third of the income, even if it's at a higher tax rate.
Yeah, I guess it's just all where it nets out, right? You'll have a higher tax rate, but lower base versus lower tax rate, higher base. The absolute dollar is what counts.
Yeah, exactly. And so, again, there's no one size fits all to any of this. I think that's oftentimes, being a podcast listener myself, it's an easy cop out for, the podcast interviewee to take, is like, well, this is all facts and circumstances, but it really is. This stuff is very complicated in application, and it can be a highly different answer from one investor to the next.
So in financial planning, do you have software that runs scenarios just to try to optimize for the least number of lifetime tax dollars or sensitivities that you run? How do you, in practice, how do you actually execute this?
Yeah, so it's a combination of software, manual research and calculations in Excel, and so on, and then in addition to that, just kind of leveraging and thinking through what are the likely outcomes for this client. Are they somebody who's likely going to draw down the majority of their portfolio during retirement, and they're not going to have a large estate at the end? Are they somebody who's thinking about, they actually do want to likely provide some gifts, whether that's charitable giving, or they may pass away and have a large taxable portfolio? They're going to have a step up in basis, and that can lead you to a situation where stocks in taxable is still the best answer. So it's all of those things. We have some pretty advanced tax planning software that we use that helps us to kind of visualize where on the tax spectrum a client actually is. So where are they on ordinary income rates? Are there any surcharges that are coming into play, whether it's additional Medicare tax at 0.9%, net investment income tax at 3.8%, where are they on the capital gains bracket? And then we can run an infinite number of scenarios where we say, well, let's set a capital gains budget this year of 100 grand. What does that do to the client situation? Where does that move them along the tax spectrum, and which marginal bracket are they going to end up in? So it's absolutely software. It's also a lot of just using Excel and Google Sheets to run calculations. We've got a pretty detailed portfolio accounting software as well that allows us to actually go through and accumulate and understand what all the income that's been earned this year from the portfolio, what do we still project for the end of the year, through the remainder of the year, and then we use all of that to kind of help inform the decision, and then talk through the client with those implications and decide, is it capital gains? Is that our strategy? Is it IRA contributions to reduce income this year? Are we thinking about doing Roth conversions? There's just so many different things that can take place, and we have to have all that information to make those decisions.
Incidentally, I know the software may be sort of prosumer specialized software, but for the geeks out there, what are some of the names of the software programs you use?
Yeah, so we use a series of software packages. So for financial planning, we use eMoney. It's one of probably the 3 or 4 major platforms out there. That's a big one. We use some software by a company called Advison, another package from a company called Covisum, as well as utilizing all the tools and resources that are available from Vanguard, from Dimensional, or DFA. So there's a lot of things that we use that all kind of fit together as part of this process that we go through with our clients.
What is the thing you use for the tax visualization that you were just talking about?
So it's a software through Covisum, through a company called Covisum. They have a tax clarity software that we use. That is, it's definitely an advisor software. It's not, to my knowledge, they don't have any consumer-facing application.
Got it. All right. Well, I'll make sure I get the links from you later for that, so I can link to those in the show notes, just for those who are curious. Okay, and then you also mentioned a moment ago that there might be some narrow circumstances where tax-exempt bonds like munis might actually make sense to hold in a tax advantage account. Could you say that again one more time, like what those circumstances might be?
Yeah, well, so in most circumstances, in most situations throughout recent history, pandemics excluded, so pre-2020, typically what you're going to expect to see, right? If you compare the yield, the yield curve on treasuries, or the treasury yield curve versus a municipal yield curve, right? You're going to have to take into account a couple different things as an investor. And this is what I think the market does take into account. One, although municipal bonds are very high quality, they're not the same as treasury bonds, right? So there is some credit risk from municipalities with municipal bonds, right? At the same time, because the tax benefit of not having to pay federal income tax on municipal bond interest, because that's valuable, that's also another component that's typically taken into account when you compare the yield on, let's say, a 2-year term, on the treasury yield curve versus a 2-year term on the municipal yield curve. You're going to see both of those things taken into account. And typically what that's going to end up meaning in most situations is that you do need to still do a calculation, what we call a tax equivalent yield, where you would take the municipal bond yield and the federal or the treasury bond yield, you'd apply your federal tax rate to try to normalize the two, to compare them apples to apples, right? So you would say, well, yes, I'm not getting as good of a yield, for example, on my treasury bond, on my municipal bond, but given the fact that that is federally tax-free, I have to normalize it to compare it, to kind of true it up to make it equal to my treasury, yield, right? All of that to say, what we did see in Q1 of this year is that there was a big flight to safety, right? Everybody thought, hey, the pandemic is kind of, it's unprecedented. It was unprecedented, right? And thinking the world's going to end, so to speak. And so there's a huge flight to safety. And what that ultimately meant is that bonds with credit risk, right? So, corporate bonds, municipal bonds, their prices dropped dramatically. And so the yields surge because prices and yields go in opposite directions. So when prices drop, say 5, 10, 15%, depending on the particular bond asset class, the yield spiked. And so when you had a yield, an opportunity for a municipal bond to get a yield of say 2, 3%, that could be pretty lucrative, even if you were abandoning the tax benefit. Even if you were saying, hey, I'm going to hold this in my IRA or Roth IRA, it still could have been more lucrative at that point in time than the other investment choices that are available to you.
But why would you hold that in tax advantaged account? Because unless it's not available to purchase in a taxable account, which I don't know when that would be the case.
Well, so if, for example, if you are like that investor we talked about at the beginning, who's only investing in their 401k. So
I gotcha. But if you had a choice between the two, would there ever be such scenario where you would it actually make more sense to hold the tax exempt bond?
Well, so it would be a situation where depending on the amount of tax advantage space that you have, depending on the size of your portfolio and how much bonds you actually need to hold, sometimes people just, all else equal, you don't want to waste any of your tax advantage space at all, right? And so in some cases you're saying, well, in order to fulfill my asset allocation, I have to own, this percentage of bonds. And I don't have enough money, I'm not going to take a distribution from my IRA and go put it in a taxable account. I would never do that. So in order to fulfill my asset allocation, I've got, this pool of money in my IRA and I have choices. I could invest in treasury bonds, corporate bonds, municipal bonds, international, investment grade bonds. I could invest in any of these asset classes. And there was a period of time in Q1 where you could have absolutely made an argument that the best bond asset class to hold anywhere was municipals because of that high yield. So it's not that I'm preferring to necessarily hold it in one account versus another. It was just the best, the best yield that was available, at that particular point in time.
Got it. Okay, cool. Let's move on to REITs. Where would you place these?
So as we're getting, kind of into a lot of the less traditional, real estate's still fairly traditional, but less traditional asset classes as we move away from stocks and bonds, I think the overarching theme is generally going to be one, they're going to typically not be very tax efficient. There's going to be a lot of ordinary income or a lot of other hoops you have to jump through as a taxpayer, as an investor, a lot of other gotchas that you really have to be careful of. So with REITs in general, they're going to be very tax inefficient. The REIT structure, real estate investment structure by definition for a real estate investment trust requires that 90+% of the income ends up getting distributed to investors. And that tends to be, is going to all be ordinary income. Now, under the tax law that passed, the Tax Cuts and Jobs Act Tax Cuts and Jobs Act a few years ago, you can, with a lot of REIT funds, take advantage of the QBI deduction. And so that can be helpful. But right now that's temporary. It's not guaranteed to be an indefinite, benefit. Right now it's going to, it would sunset about 5 or 6 years from now. And so that's not an indefinite benefit. Second, just because of the taxation and the application of that for most middle income to high income investors and the tax complexity that goes along with it. Even though that QBI deduction is helpful, I still don't think that REITs really belong in a taxable account for most investors. So I still think a tax advantage account is going to be preferable. Although in some cases it's not, REIT income is not as punitive or as bad for low income taxpayers. But in general, it's going to be better in a tax advantaged account.
Okay. What about physical real estate? Because you can actually hold this in a tax advantaged account. As you know, you can have a self-directed solo 401k or Roth 401k or IRA variety. Or you could just purchase real estate in a fully taxable manner.
Yeah, so this is an area that's really littered with potential issues and trouble. So it's not something that we spend a lot of time on. Oftentimes, one of the biggest concerns that comes up is people tend to buy. Well, if they're doing direct real estate investment, they'll tend to buy things that they know or that they have a connection with, and that's hugely problematic in an IRA. You can't have a benefit from that asset while also investing in it. That can be hugely problematic. So you can't go and put a vacation property in your IRA and then you use it part-time, and then you also treat it as an investment. So there's a lot of problems that can exist, with direct real estate investment inside of an IRA, not to mention, where do you actually custody this, and a lot of other issues that arise. So it's not something we tend to really focus on, terribly much. But I think in general, if you look at direct real estate, investments, oftentimes where investors are going to find the most value out of them is actually by owning direct real estate just inside of an LLC or an S corp or something like that, because you get to take advantage of depreciation, and because you get to take advantage of losses and be able to carry forward losses if you're actively invested in the real estate and so on. So usually, for clients that we have where they own, a real property asset, they've got rental income or something like that, they're typically going to end up finding the most value to do that in their taxable account. And so, on the IRA side for a direct investment, it's just an area investors have to be very, very careful of, because it can lead to a lot of potential issues in terms of tax compliance if you're not careful.